So are we talking rates today?
Yeah, absolutely. We're talking rates today.
What kind are we going? Mortgage rates or are we going Fed rate today?
I think we're going to go mortgage rates today. Everyone's talking about the Fed rate. Let's talk about mortgage rates. You guys, welcome to Market Shares. This is Tony Blodgett, and I'm back with my co-host for the day, Dan Keller. He's been my co-host a couple times, but hey, what the heck? We want to talk about mortgage interest rates, not so much what they're doing. We know what they're doing. They're going up. They may come down at some point. That's a whole nother episode. We'll talk about what's going to bring rates down because it will happen. But what I want to talk about more specifically is how do you deal with an increasing interest rate environment as it relates to presenting financing and mortgage options to your borrower, especially when they're probably going to hear a number they didn't expect. And what does that do? Well, that triggers them to shop around a little bit more. How can we combat that? How can we get ahead of that? And how can we make sure that all of the hard work that we do with our clients, because look, I know how it is. There's low inventory everywhere. You're spending so much time in the lead incubation and keeping your clients engaged while they try to go through all these different offers and contracts, and they finally get in contract. And I'm hearing it from everybody. All of a sudden, you tell them what the interest rate is. It's in the high fours, the mid fours. They're expecting the high threes. Next thing you know, they're shopping around, and you're fighting for your life to win that deal. I want to talk about a couple strategies that we can do right now to help keep that from happening to you and your business. Because look, the reality is everyone's rates are about the same, but once you get into that shopping scenario, then it's a race to the bottom, and you have a high likelihood of losing a client that you've put a lot of time into. Right, Dan?
Yeah, I mean, I can share two examples with you right now. It's kind of almost an A/B split test of how even when you try to do it right and you're coached to do it right, you sometimes get it wrong. And the mistake that I made, so I had a client, Kevin, for example, we just talked about him today, where I had to fight to keep the fish on the hook. We got mutual, but here's the thing. He was mutual on another property a little over a month ago, that ended up falling through. He was able to exit the deal. Well, we had him locked, and we had him locked in the upper twos because it was from a month prior to that, right? With a point. And so then anyways, he goes back out shopping. He goes and gets mutual 4 days ago. We sent out disclosures, and I sent out disclosures, and they're in the mid upper fours. So Ding Dong Dan didn't stay in good enough communication with Kevin as he was going out and writing his next. He was already fully underwritten approved. Shoot, he'd already been fully through underwriting on another deal. Had I kept him in the loop going, hey, Kevin, rates are going up. I want to let you know that, hey, rates are going up as you get mutual in this new one. Nope. I just sat back and we sent out disclosures. Well, I ended up getting shopped because that 4875 that we sent him was massive sticker shock compared to what he expected. So then he goes to the internet, and of course, what happens when you go to the internet? You get the ads, and you get the quick ins, and now we got a mess. Better scenario. Client of mine that follows me, he's a past client of mine, so he gets my weekly Making Sense of the Market videos. He sees that I've been talking about rates going up every single week. He sees that I did a video on second homes, the loan level pricing adjustments for second homes. They just went out and got mutual on a second home, sent him disclosures in the low fives with points because that's where it's at. Didn't even bat an eye.
Right.
Man, rates are up. Man, this isn't that 275 you got me last year on our other house. Nope. But because of communication, setting proper expectations, no problem with that. But because I did it wrong on the other end, now we're fighting for our life.
Yeah, so I mean, I've been training on this for years, and it's more important now than ever, which is, look, when you're pre-qualifying your borrower up front and you get to the point where you're going to talk about interest rate, because look, guys, if you're not having an in-depth initial consultation with your borrower where you're having, not send them to your website, but having a conversation with them about what are their goals, what is their income, how much cash do they want to put down, and then kind of working up an estimate of what their payment's going to be. I mean, this is the best practice. And through that process, what I always would do is quote an interest rate that's 1/4 to maybe even 0.5% higher in rate than where we are today. And then let the client, especially when in an increasing interest rate environment. So you're saying, look, this is not where rates are today. We're not shopping for a rate, we're pre-approving you, but we're going to set the expectation that the payment could be much higher, because the reality is that rates have been increasing, and the last thing that I would ever want for you, Mr. Borrower, is for you to find a house, get into contract, and then be surprised. So this really is about setting the proper expectations, and that can be done through that initial consultation. And then to Dan's point is that while the person, look, our lead incubation time is so much longer than it's ever been because of the lack of inventory. And so it's not just about doing your status updates, checking in with them every week, which you should be doing. It's making sure that during those updates, you're continuing to bring up the interest rate conversation and you're bringing them along with the market. So once they do get into contract, it's no surprise to them. I think another thing that you can absolutely do, and Dan does this really well, and I'm trying to get more and more loan officers that work with me to do this, is use Mortgage Coach as a tool to present multiple loan options. Look, here's the reality. Your client's probably going to have sticker shock. To Dan's point, they're going to go online. When they go online, they're going to see a lower rate. That lower rate's probably going to have some points associated with it. In most cases, in today's market, it is not going to make sense to pay points because we know that this is a cycle. And when inflation gets under control and we potentially go into a recession at some point in the near future, rates are going to come back down and these clients are going to refinance, and any points they pay would be a waste of money. We know that, but it's incumbent on us to show them an option that might look similar to what they would find online, and then show them an option that you would recommend and explain to them the difference and why you're recommending the higher interest rate in today's environment. That's a way of getting ahead of what they're thinking. Don't let them do the research on their own. Do the research for them and then present those options. I promise you, if you do that diligently, you are going to get shopped less often and your clients are going to be more confident with the advice that you're giving them. What else do you think?
Yeah,
Dan?
it's communication. I mean, I learned the hard way. It's communication, and it's not just with your clients. It's with your coworkers. It's with your spouse. It's with your kids. So biggest takeaway is communicate. Just don't be afraid to communicate too. Like that's why I make my weekly Making Sense of the Markets videos, and I send them out, and I do a rate range. Like, hey, rates are up or down week over week, and here's kind of the range where they're at. Just so that people that do follow me, because it does go out to pre-approvals, it does go out to past clients, they can see that. So don't be afraid to have those conversations.
I want to touch on one last thing, which is you have to realize that the lenders that predominantly advertise online, who you would see on NerdWallet or Credit Karma or these rate tables, these are lenders that are predominantly refinance lenders. Well, imagine what's going on right now in their companies with so many refinances going away. They have all this staff, they have all this infrastructure, and they are desperate to get loans in the door. So what we're seeing is that these lenders, more than what they did in the last 2 years, they're being extremely aggressive with their rate quote. So you need to look at the disclosures, look at the disclaimers. Many of them have 3 points or more, but worse than that, what we're seeing today is that if you look at the language on websites like NerdWallet or Credit Karma, they explicitly say these rates are not necessarily available. It's really just an advertisement with very little to substantiate that interest rate. The websites that are aggregating these leads do virtually no due diligence to make sure that these lenders are actually able to offer the rates they're quoting. And more so than ever, what we're seeing in real life is that the rates that you see online aren't available even with discount points to be paid. It is a different world than we saw even 60 days ago in the online market because of the desperation of these refinance lenders doing whatever they can to get rates out there. You might even call it a bait and switch tactic, but through disclosures or lack of disclosure, they're able to thread the needle on the legality of this. And so that's what we're seeing in the market. And you need to preface this. You need to set your clients up for that expectation. Use a tool like Mortgage Coach, get ahead of it, and then set the expectation. And as time goes on, continue to update your clients on what to expect with rates. And by doing all of those things, I promise you will be able to retain more of your clients. You'll get shopped less often. You'll have less pricing exceptions. And look, guys, you can actually write some profitable business. And that is going to be really important in these lower volume months that we're seeing. So those are my thoughts on preserving interest rate, getting shopped less often. Dan, I know that you're in the trenches like everyone else dealing with these challenges. I appreciate you coming on and helping me unpack this topic a little bit. Thank you guys for tuning in, and look for more episodes like this of Market Shares, where we're going to not only give you updates on what's really going on in the market, but also strategies and tactics to be the best loan officer or manager that you can be in this space. Until then, take care, and I appreciate you tuning in.